Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Antonio. It's fantastic to have you back on the podcast show.
Hi, how are you, Bilal?
Great, thanks. Now, a lot has been going on in markets so far this year. And one of the things I notice in your writings is that you always like to come back to financial conditions as your favorite sort of measure of the state of the economy or how things are going. Maybe we can start with that. Why look at financial conditions? What are financial conditions? And what is it telling us right now?
Yeah, thanks. So, yes, it's many years that I have been looking at financial condition, even before meeting you. And I remember having access to a lot of financial condition indices and so on. One that now is quite popular is the one that also the Fed is releasing. So the reason I think is key, financial condition, but it's not just my opinion, many people in the financial market look at financial condition, is because it's a measure basically of how easy or difficult it is for households, businesses, government to obtain financing, to borrow money, is related to the value of the collateral that one can borrow against. So it's a key measure that includes different market variables that measure how easy is to borrow money, to get financing, to lend money, and so on. So in practice, you have different components, which is long and short-term interest rate, mainly long-end interest rate, credit spread, equity. They are extremely important, in particular equity, because it's linked to the net wealth. And we know net wealth is so important, in particular in the US cycle, but also on the European cycle. And Europe has been remarkably resilient. Probably also because of, in general, financial condition being quite loose, together, of course, with excess saving that in Europe are always elevated and very low unemployment rate. But so interest rate, short-term, long-term, credit spread, equity prices, and the dollar. So the dollar is another very important factor, I would say. So I don't just look at financial condition, but I like a lot to have a market-based leading indicator for the economy. That's I like a lot.
And so what's it telling us right now? Because presumably stocks are doing well, the dollar's weaker.
So let me start with this. As you know, for many years, I have been bullish the US economy. In particular, even when I joined in October, the first thing I did, I tried to set up quickly some short rate trade because I was really convinced the economy was strong. And basically, I didn't believe we were anywhere close to a recession. I don't think we are close even now to a recession. So recession, I don't think we are close to a recession. But since the beginning of the year, I turned a little bit more bearish on the economy, essentially for a few main reasons. The first one is that the Fed, after cutting quite aggressively 15 September and another cut, I think after, then they were on hold, and they've been on hold. The second reason is that Trump started to talk about tariffs, and I still believe tariff will have an effect on inflation, but they will also have an effect on slowing economic activity because they affect consumer confidence, they affect businesses, they affect capex, and in general consumption, and 70% of the US economy is consumption.
And then Antonio, also just on tariffs, I mean, there's a debate in our circles around, is it tariffs that causes the slowdown, or is it the uncertainty around the constant changing in tariffs? Which of the two, in your view, is the driver here?
I think it's a bit of both, because tariff create uncertainty. Uncertainty means less investment, sometimes less consumption, even if this time you have the net wealth effect driven by the equity market offsetting that. On the other side, also tariffs will eat part of the margin probably in the companies. So I think it's a little bit of both, and no one really, including me, no one really knows exactly how is the split. But what I would say, coming back to what I was saying before, is that, so Fed on hold, tariffs, of course, and thanks for your question because it helped me to clarify the point. And then you had financial conditions that were becoming tight, in particular the long-end yields were quite elevated in January with the 30 above 5%, the swap spread getting on the negative side, so tighter financial condition. And on the top of that, the dollar being very strong. As we know, it was at the peak, the dollar. The only thing that was not tight was the equity market and credit spread. So credit spread were low and the equity market was very strong. Now, I have to stress that there is a strong correlation if you advance the long end yields or the term premium with respect to economic surprises in US. They tend to lead. And indeed, my call back at the beginning of the year of a slowdown, with growth going around 1.5%, was mainly due to these three factors, including the tightening of financial condition driven by long end yield and by dollar. Then, of course, what we had a slowdown, which you can see in the latest jobs numbers that has been revised lower. You can also see in the real personal consumption, which has been flatlining for the second quarter. The first quarter still was up, but we are more or less at the same level we were at the end of last year. And if you take the quarterly changes in the real personal consumption in the US, so in real terms, and of course seasonally adjusted, they tend to correlate actually with the equity market, which would send a bearish signal at the moment to the equity market, because the quarter over quarter change in the real personal spending, it was up at the peak 4%, now it's back to 1%. Again, because real personal consumption is flatlining, it's not dropping. So we're not talking about a disaster. We are just talking about a slowdown. So the slowdown has happened. Then, of course, everything was helped by Trump going a little bit too hawkish on tariffs on the Liberation Day. So with a nice table, the formulas and so on. And then, of course, we had the equity sell-off. So that was another tightening of financial condition. Now, the debate is open if the slowdown we see now is due to the equity coming down in April due to that fact. I think it's a combination, fed on all the long end deals and then premium still elevated, then tariffs, that have had an effect on capex, on confidence, on consumption. At the same time, the equity sell-off, which has now reversed dramatically. So when you ask me if now the economy is going to slow down or not, I want to answer in this way. I think it's a very difficult question at this point, because we had quite a decent slowdown. The market has priced already a good amount of cut. In particular, when I look at today, the market is rallying because Besten said the rate should be 150 basis points lower. So Besten is helping to price more cut, of course.
And just as a timestamp, but we're recording this on Wednesday, the 13th of August, just for people's reference.
Yeah. And the market is pricing in the US more or less by the end of the year already 63 basis points of cut, and by June 110. So the market is already pricing now after the non-farm payroll have been revised lower. To me, my base case, by a small probability higher than 50%, is still that we will get some more slowdown because of the reason I said before. But on the other hand, I would be blind and I would not be objective if I don't take into account the equity rally, which has eased financial condition on that respect. I don't know exactly when it's going to play out or not, but so I have still a base case of some further slowdown. On the other side, the market has already priced a lot, so I don't think I would like to have a huge risk as a bet on that. Some risk, but not huge. Second, the easing of financial condition, the pickup in lending, the pickup in credit, and so on, which is going on, could smooth this economic cycle. And so the slowdown, I don't think as further slowdown as 90% probability. I think is a little bit higher than 50, but not too much higher. Last thing I want to add on that is that clearly there is a huge uncertainty at the moment about the economic data. Response rate in the non-farm payroll have been coming down for more than a decade. So we know there are problems. In the UK, we have an example. The data every time is revised opposite with respect to the previous month. So previous month lower is revised higher. And these are regular statistical regularity. So it means there is something, of course, in the data collection. In the US, we have problem with data, but obviously the fact that the president has decided to fire the person responsible for the BLS for this revision, and now is suggesting a new person, which has been very critical about the BLS, and yesterday has suggested that maybe data could be published every 3 months. We don't make any judgment, of course, on politics, but as economists and strategists, we understand that this creates a little bit more uncertainty, and it could create a situation in which maybe if the data is published quarterly, you can have naturally a smooth in the data could be smoother, and then show less of a downside just because of the proposal that the new person that will be nominated probably at the head of the BLS has said yesterday. So I'm just taking the information into account. So bottom line, slightly higher than 50% of a slowdown, no recession, but I'm looking for sign that suggests that there could be some acceleration going on. And at this point, all my leading indicator based on all the other part of financial condition are suggesting a slowdown, but the one based on dollar and equity are suggesting a little bit of the opposite. That's the reason I don't think is for sure a one-go type of bet.
And on the equity side, many people have commented that it's a very narrow rally. It's essentially the big tech AI type companies that are really charging ahead, and the rest of the index isn't necessarily doing as well. So does that, make you more cautious about, interpreting the equity performance in relation to the economy, or is that always the case? There's always periods where a narrow sector outperforms, and so we shouldn't try to slice and dice it too much.
So the problem of equity is not the fact that has rallied a lot, so for some reason it should come down. It's possible that it keeps going, but equity is priced for continuous earning growth above 10%, or at least 10%, above 10%, which is a lot. If I think that at the moment, the growth in non-farm payroll, especially in the cyclical sector, I've published a lot in the recent months on that, but to be short, these are the sectors that are the most important for hiring, for the dynamic of the economy and so on, have been close to zero recently. And if I look at the fact that, as I said, real personal consumption is kind of flat, I think for equity to deliver that kind of performance will not, equity needs to keep rallying like it has done to deliver that kind of earning growth. So I see some possibility of disappointment beyond the fact that it's a very narrow rally. Having said that, there are a few external factors that are helping equity, which is first, every time the US administration talks about removing Powell, talks about cutting coupon issuance, which has not happened in the latest QRA. They didn't do dramatically. Every time they talk about, they fire the BLS employee, and they talk about, publishing data quarterly, maybe. This stuff tends to be bullish equity, because clearly it tends to shorten the slowdown of the economy perceived in the statistic, or it tends to fuel expectation of more cut, because clearly firing Powell or Bessent saying 150 basis points of cut, it is clear to everyone that the next FOMC will be more dovish than this one. So Kugler is left, and we have Miran. Miran means lower rates to me, to be honest. For sure, he's a great economist, PhD at Harvard, but it's clear, has been nominated basically by Trump. So I don't think he's going to be an hawkish member of the FOMC board. So at the moment, equity are benefiting from the fact that if it is a slowdown, but as I said, not a recession, then the Fed is going to cut, is going to benefit equity. On the other side, I think there could be still risk that the fact that the slowdown, if it is real, then earnings are are difficult to deliver what the equity is pricing. So I can see a sell-off between 5 and 10%. I think it's difficult to get more, also because Trump has a clear history of, changing back his mind in terms of tariff and so on. So if we start to get equity down 5 to 10%, he might decide to have a more soft stance. But at this point, I don't think they are necessarily a full-on trade because they are priced for a very optimistic scenario of the economy, which I don't think will materialize. So I think they could go a little bit higher, but I wouldn't be surprised if by September they are lower 5 to 10%.
Okay, and then in terms of the Fed and rates, the market is pricing a 25 basis point cut for September, and you said it's pricing almost over 100 basis points of cuts by the middle of next year. So do you think there is an opportunity here to go long rates, I position for the market to price more easings or not?
Yes, so I see two scenarios. One scenario in which, so let me say first, yes, there is. So I'm positioned for short-end yields to go lower because of the slowdown that I still expect to come in the data, assuming they publish the data and assuming that clearly, I don't know. After what they said, maybe it's difficult to have very weak data. I don't know exactly about that. Let's see how it goes. But clearly, there is some risk there that the picture is going to be difficult to interpret. But usually, the revision are lower when the cycle is turning. So you can assume that the latest 73,000 non-farm payroll could be either revised down. In that case, so I think it still makes sense to bet on lower short-term yields, in particular looking at some maturity around 26, not really 25. But I would say if the market from here prices 25, 30 basis point more cut, then I think that bet would have delivered a good amount and probably would not be very sure to remain in that bet. So from here, suppose we get some weak data, 25, 30 basis point of cut priced in more with respect to today, then I think is a time to get out of that type of trade, I think, in my framework. On the other side, I also like, exactly because I think also on inflation, we will touch probably later on inflation, but I like to be short the long end of the curve. So I think there is room to see another fixed income sell-off, either part of you sell all US dollar assets, so dollar down, fixed income down. Why fixed income down? Because clearly we are in a situation in which the Fed might not immediately, I don't think it's going to happen immediately, but they might cut more than is currently priced. Therefore, the long end, given the fiscal deficit that is quite elevated, if I remember correctly, around 6, and is not giving too much of a fiscal impulse because it's not going to jump to 9 or 10, but it's still elevated, and inflation to me is not over, then we could easily see a sell-off in the long end, and also is a partial edge with respect to the fact that if the data turns strong for financial condition, I said before, I would like to have some exposure on that. So that's the way in which I like at the moment to position. Then we will see the data is very crucial. The data from now to September, because we have retail sales, we have another non-farm payroll. This is key. And let's see how it plays. We just had CPI, so for inflation we have more information already.
And on the curve trade, one concern is that it's a crowded position. A lot of people have that trade on, or say they have that trade on, or like that trade. Some kind of curve steepener, 2's10 steepener, 5's 30 steepener. Is that a factor that you take into account, or do you think the fundamentals are so strong that we shouldn't worry so much about a trade being crowded potentially?
So I think I think now there is a worry, but apart from being crowded, my worry is that we could have some stabilization in the data. And given that I think inflation is not over, you can get a sell-off in the short end, and the curve could bear flatten. So you could get 2-year selling off and 30-year rally. Because obviously, if the data is, bear flattening case in which the Fed turns like more hawkish, which I don't think is going to happen, but you can easily have a sell-off in the short end if the data, retail sales, and next non-farm payroll are strong. Then you get a sell-off in the short end, and the curve doesn't do anything. But in that case, I think that's the reason I like to be short on the 30-year, because I think the 30-year will still give a protection. But again, this view is, is related to the data in the next 2-3 weeks. Is very key. And I would say it will also depend on the US administration, in the sense that the impression that we have as observer, it seems that they keep pushing on the, Fed cutting. They keep pushing on questioning the data when the data is not something they expect. So I think if they keep this type of narrative, this could help this trade that I'm mentioning. If they flip and they start to be not to talk anymore about this factor, of course, you could have also the short end having more problem to rally. But I would think if the data weakens, clearly there will be more talk about Fed should cut from the US administration, I would say. So it's not an easy situation, because there are many concurrent factors playing together, including, the politics, which is part of the game, and I think it's quite relevant at the moment.
And you've mentioned inflation a few times now. I mean, what's your views around inflation?
So I think the print yesterday, for sure it was, I think we can agree that the good news, which the market celebrated greatly, because Nasdaq, I don't remember where it finished, but it was very high. So the fact that, core inflation, excluding used car, as you were also showing yesterday, and excluding also new vehicles and so on. So the core inflation that measure the pass-through of tariff was
core
coming
goods,
down. Yeah, excluding this component was coming down. So that's the first factor. Okay, positive. Second factor was that obviously this can be taken as a signal that the situation is fine, but I would be very cautious about that. And that's the reason, again, on the short long end yield. So the first is that when you check where is core good inflation with respect to the previous year post-pandemic, core good inflation is still more elevated than in 2023 and 2024. So less pass-through, so it came down. So it is less elevated with respect to the previous bond, but it's still more elevated with respect to 23, 24, and with respect to the median inflation between 2010 and 2019. The second point I want to make is that...
and that's because core goods normally trends down over time.
Yeah, so core goods was very, very negative, and then service inflation in the last year and so on was still stuck at a high level. Now core goods is picking up. What I'm saying is that core good inflation is still, from seasonal perspective, is still higher than it has been in 2023 and 2024, and in the median of pre-COVID and post-global financial crisis. The second point is that when I look at the part of the year in which we are, typically the core inflation tends to come down at this point, core CPI. Instead, at the moment, core CPI is running higher on a season, if you check with respect to 23 and 24 and the median before. So it's not that low, that inflation, and we are in a part of the year that should be kind of lower. The other point, which other people made, is the inventory thing. So inventory went up before the tariff, then they came down. So far the pricing probably has been affected by that, but going forward, it will be more based on tariffs and so on. So inventory low means that now firm, they have less good in the inventories that they built up before. Inventory came down, and now the pricing of their goods will be set based on tariffs also. So I wouldn't infer from yesterday that is all a green light on inflation. Also because when I look at services inflation, excluding housing, was quite elevated. Of course, there are reasons for that. But I still think it was almost 0.5. And on the top of that, if you look at a few leading indicator like ISM price paid, it really went higher. And lastly, which this stuff people are talking about, that is nothing new what I'm saying, but something that I'm saying that is quite new is that my own personal leading indicator based on financial condition for core CPI momentum is still grinding higher. So what I'm doing here, I don't have the chart, but I'm going to explain verbally, is that I'm taking the Fed financial condition index. I'm advancing by a few months, and I check its correlation with the changes year over year in the core CPI year over year. So you take core CPI year over year, 3.1, 3.2, 3.3, and you check year over year changes of that number, which is the speed, I call it, the core CPI momentum. So easing financial conditions tend to push higher, and is working very well. And that's the reason I like to keep the short on the long end. Also assuming that if the Fed does some maybe 50% cut in February, in September, like they did in previous September, I think the bar is elevated to do that, because I don't think they want to do that unless the labor market really shrink a lot. But if they do, then the long end could sell off like it happened in October. So for the time being, I want to keep some exposure for a further slowdown under reason, not with too much risk. And I want to keep some exposure on the long end for the inflation, fiscal deficit I'm talking about, again, with some risk, not too much risk.
Okay, great. Now, we've spoken a lot about the US, and I know you've recently started to look a bit more at Europe. So, just as a kind of bird's eye view on Europe, I mean, what's your take?
Yeah, so there is Euro and UK. So let me start quickly on the UK. That was we had the Bank of England meeting recently. So the first thing I want to say is that it was a meeting in which they were clearly uncomfortable about cutting rate. So in the press conference, it was evident that they were not very comfortable, because in their forecast, inflation is going higher. It is going higher. So the sticky inflation in UK, it could mean that the cut they have done is the last one, and they're not going to cut anymore. Now, the market is already pricing close to that now after the meeting. Indeed, if I check in the UK now, they are pricing, usually, the pace of cut was every other meeting. So November, we should have got another 20. In November, we should get another 25. In February, another 25. And in February, April, another 25, every 2 meetings. So at the moment, the market is pricing less. And I would agree, because first, I don't think the labor market is so weak as previously thought. I have started very recently to look at UK, so I don't want to give too much confidence. Maybe I have more in the US, but I would say that there is a risk that this has been the last cut for the Bank of England. Even if, of course, there are headwind also to growth in the UK, and also the Bank of England made clear that they were uncomfortable, in cutting rate. Okay, Bailey said, no, we are still on downward path. He didn't look very convinced. On the Eurozone, I think it's a kind of similar situation. So we should get another cut at the next meeting. If I look at what the market is pricing, So yes, on the Eurozone, yes, sorry, no, what I wanted to say is that the economic situation is a little bit of a mix because as we know, Germany has done extremely poorly in the last few years. Industrial production is very depressed. On the other side, the labor market is still resilient and quite strong. Unemployment rate is low. And looking at the different members of the governing council, clearly there is a Schnabel that says that the bar for further cut is very elevated. So I would say that also in the Eurozone, I would not be sure that we get another interest rate cut. So we could be done. So I don't at the moment buy into the story that the Eurozone, is kind of collapsing and they will cut more than priced. I'm actually thinking that they might not really, they could be done in cutting. Also because again, inflation has been stronger than their forecast. So they could revise up their forecast. Clearly, many people think that inflation will soon collapse. I'm not so sure about that. So for the time being, I would be cautious and think that with the sticky inflation and so on, also on the Eurozone, maybe optimistic assumption about cut are overdone.
I mean, so we're in an interesting situation where the European central banks are close to ending the easing cycle, and then we have the Fed about to resume an easing cycle. So do you have a view on the dollar as well?
So on the dollar, I think, so on that perspective, it should be bearish dollar, of course, because the interest rate differential will go more against the dollar. Interest rate differential have not been a big driver of the dollar recently, because as we know, the dollar, has responded to other factors. Now, to me, the dollar at the moment, on balance, I still remain bearish dollar. The reason is mainly the risk premium built into the dollar. So one reason is, of course, what you said. So maybe more cut in the US with respect to the rest. Clearly, if that dynamic reverse, because we see a jump in data, extremely good data, and the other country with data, then of course it would be a factor. But for the time being, I think I still remain on the bearish side. And the dollar, what I want to say is that it's still weaker than many of the leading indicators are suggesting, because when I look at the performance of US equity versus the rest of the world equity, US equity standalone or economic surprise in the US, the dollar should be stronger. But every time the dollar gets hit, as we have seen recently, by a lot of risk premium built into the dollar, I think by design, because as Trump said many times, they don't want a very weak dollar, but they want a weaker dollar. And every time you talk about cut like today, every time you talk about not publishing data, every time you talk about firing Powell, every time you talk about you fire a person that is publishing data that are weaker than people were expecting, then right or wrong, I'm just observing, maybe, it's right, but the dollar goes down. So the real scenario in which dollar goes up, if there is the acceleration of the financial, the equity and so on is suggesting. So my confidence from here on lower dollar is probably not 100%, is lower, but I'm still on the lower dollar. It could flip soon because I think many other leading indicators suggest to be dollar higher. But for the time being, I remain on the bearish dollar side.
Okay, that's great. Okay, so we've covered a lot of ground. So thank you very much for all of that.
Thank you.
What's the best way for outsiders or listeners to follow your views?
So I post not very regularly, but quite from time to time in LinkedIn. That's the main source. That's the main place in which I post a few interesting chart or views and so on. So it's mainly LinkedIn. Yeah.
Okay, great. Okay, so with that, thanks a lot, Antonio. Keep up the good work, and hopefully we'll speak soon.
Thank you. Thanks a lot for having me. Thank you. Bye-bye.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.